It's 11:30 p.m. You're lying in bed, phone in hand, endlessly scrolling Zillow. Every house under $500,000 looks like a DIY demolition project. Popcorn ceilings, honey oak cabinets from 1987. And then you find one that looks almost decent. 3 bedrooms, 2 bathrooms, $515,000. You tap through the photos: laminate countertops, a kitchen that hasn't been updated since 1994. And then you get to the last picture, the one they clearly tried to bury. The backyard fence is completely collapsing. But the listing description? It has the audacity to call it a cozy starter home with great bones. You start running the numbers in your head, calculating your take-home pay, wondering if you somehow missed a memo or if the entire US housing market has completely detached from reality. Here's the short answer. To safely afford a $500,000 home in 2026, your household needs to earn roughly $180,000 a year. The median US household income is about $84,000. That's the gap we're dealing with, and that's not my opinion. That's just the math. Welcome back to Invest with Alex. Today, we're breaking down a taboo subject the real estate industry desperately wants to keep quiet. Who can actually afford a $500,000 house right now? And I don't mean who a predatory lender will approve. I mean who can actually buy one without lying awake at 2 a.m. praying their transmission doesn't glow. Let's start with a simple, uncomfortable fact. In dozens of major markets right now, $500,000 is the floor, not the ceiling, the floor. It doesn't buy you a sprawling estate with a 3-car garage. It buys you 1,200 square feet, one outdated bathroom, and a yard the size of a parking space. And yet, the median American household earns about $84,000 a year. We're essentially expecting average earners to buy homes that cost 6 times their annual gross income. If that sounds mathematically disastrous to you, congratulations, you are paying attention. But the mortgage brokers on TikTok will swear it's totally doable. So let's actually do the math. Let's start with the down payment, which is basically the graveyard of homeownership dreams. The traditional rule is 20% down. On a $500,000 home, that is $100,000 in cash. The median savings account in America holds about $8,000. You aren't just a little short, you are $92,000 short. Even if you aggressively saved 10% of that $84,000 salary every year, which is incredibly hard with today's cost of living, it takes you over 10 years to hit that target. And that assumes home prices flatline for a decade, which we both know they won't. So you do what most people do. You put down 5 or 10%, and the moment you do that, you unlock something called private mortgage insurance. PMI is essentially a poverty tax. It's an extra $200 to $400 a month that you pay not to reduce your balance, not to build equity, but purely to protect the lender in case you can't make your payments. They're charging you extra money because you don't have enough money. The down payment problem is actually the smallest issue here. The monthly math is where things get really scary. Let's say you miraculously scrape together $50,000 for a 10% down payment. You're now financing $450,000 at today's interest rates, which are hovering somewhere between 6 and 7%. Your base principal and interest payment around $2,800 a month. But we're nowhere near done. Add $500 a month for property taxes, depending on your state. Add $300 a month for homeowners insurance, which is surged along with construction costs. Add $417 a month for maintenance. That's the standard rule of thumb. 1% of the home's value per year set aside for the moment something breaks, and something always breaks. Then add that $300 PMI penalty. Your real housing cost? Not $2,800, not $3,200, not even $3,800, $4,317 every single month. That's not a mortgage payment. That's a lifestyle. And that's the best case scenario. Here's the part nobody puts in the listing. Houses break constantly. The water heater fails. The HVAC system dies during the hottest week of summer. The roof starts leaking right after the rainy season begins. None of those repairs cost $200. A new HVAC system runs $8,000 to $12,000. A roof replacement can easily hit $15,000. Replacing a sewer line, 5 figures. Renters call the landlord when something breaks. Homeowners call their bank account. So that $4,317 isn't the worst case monthly cost, it's the dream. Here's the question that should be bothering you right now. If the average American household can't afford a $500,000 home, why are these houses still selling? Who's actually buying them? Because the answer to that question reveals something about this housing market that most people misunderstand. There are really 4 groups driving the market right now. Group 1, dual high-income households. 2 people each earning $90,000 suddenly becomes a $180,000 household. The math starts to work, not comfortably, but it works. Group 2, family money. A huge percentage of down payments aren't coming from savings accounts, they're coming from parents. Intergenerational wealth transfers have quietly become one of the biggest forces in housing affordability. Group 3, equity movers. Someone who bought a house in 2014 for $250,000 might be selling it today for $600,000. They're not saving a down payment, they're recycling one. That's a completely different game. Group 4, investors. Large institutional buyers and small landlords are still purchasing homes because they're treating them as long-term assets. They don't need to live there, they just need the math to pencil out as a rental. So when people say houses are still selling, what they really mean is that the people who already have money, equity, dual income, or family wealth are keeping this market alive. First-time buyers on a single income, they're largely being priced out. Now, you might be wondering, how did we even get here? This didn't happen overnight. Between 2020 and 2022, mortgage rates fell below 3%, the lowest in modern history. That created the biggest demand shock the housing market had ever seen. Millions of buyers flooded in at the same time. Bidding wars became standard. Homes sold sight unseen, and prices in mid-sized cities that used to be affordable, Austin, Nashville, Boise, exploded almost overnight. Then rates went back up, dramatically, but prices didn't come back down. Why? Because existing homeowners who locked in 3% mortgages refused to sell. They'd be trading a $1,500 payment for a $3,500 payment on the same home. So inventory dried up. And low supply combined with persistent demand keeps prices stubbornly high. Add zoning restrictions that prevent new construction in most desirable cities. Add remote workers from San Francisco and New York buying in cheaper markets and outbidding everyone when they get there. Home prices have surged over 400% since 1990. Median wages have grown about 180%. The math isn't just hard, it's structurally broken. Now here's the part nobody talks about. The most dangerous part of all of this isn't the mortgage payment, it's the social pressure that walks you right into it. Nobody posts their mortgage anxiety on Instagram, they post the house. They post the keys photo, the first dinner photo, the backyard barbecue photo. And from the outside, it looks like they made it. What you don't see is the spreadsheet, the one where every single dollar of their paycheck already has a job before it even hits the account. You've also heard it your whole life. Renting is throwing mooring money. That line has sold more bad mortgages than any predatory lender ever could. It ignores property taxes. It ignores maintenance. It ignores PMI. It ignores the opportunity cost of a $100,000 down payment that could be invested instead. Renting isn't failure. In the wrong market at the wrong price, buying is the financial mistake. Let's look at a real example. A couple bringing home a combined $160,000 a year. After taxes, healthcare, and modest 401k contributions, their take-home is roughly $9,500 a month. Subtract $4,317 for housing, you're down to $5,183. Now subtract life. $800 for 2 car payments, $250 for auto insurance, $300 for gas, $600 for student loans, $400 for out-of-pocket health insurance, $800 for groceries, $450 for utilities, internet, and phones. they're left with $1,500. That $1,500 has to cover clothing, kids' activities, car repairs, medical copays, and occasionally leaving the house so they don't lose their minds. Emergency fund, retirement beyond the minimum 401k, investments, gone. This is what being house poor actually looks like. Six-figure income, zero financial margin. They're not building wealth, they're feeding the house. Here's the part the industry doesn't want you to hear. The realtors, the sellers, the mortgage brokers, nobody in that transaction gets paid to tell you that you're about to financially drown. The deal closes, everyone collects their commission, and then you're alone with a 30-year commitment and a leaking roof. That's not cynicism, that's just how the incentives work. And society has wrapped this whole trap in the language of the American dream, like house poor is just part of the journey, like stress and financial panic are a badge of honor. They're not.
There is absolutely no trophy for being house poor. Real wealth isn't about forced equity you can't access. Real wealth is margin. It's cash flow. It's having the ability to invest, absorb a crisis, and actually sleep at night. Roughly 65% of Americans already own a home, meaning a large chunk of the market is being sustained by people who already own, not people just starting out. If you're a first-time buyer waiting for the market to make sense, you're not doing it wrong. You're just being honest with the math. Financial guidelines say housing shouldn't exceed 28% of your gross monthly income. To afford $4,317 a month under that rule, you need a household income of about $185,000. Even if you stretch it to the absolute maximum debt-to-income ratio banks allow, around 43%, you still need to be making $120,000 to $150,000 comfortably. About 80% of American households don't hit those numbers. So here's my honest take. If your household earns under $140,000 a year, do not buy a $500,000 house right now. I don't care what the bank pre-approves you for. Their risk tolerance is not your stress tolerance. You can't out-budget a systemic affordability crisis. You can't skip enough avocado toast to save $92,000. Renting and investing the difference is a legitimate wealth-building strategy, not a consolation prize. Run your actual numbers, not the numbers the mortgage broker shows you in the sunny scenario. The real numbers. The HVAC fails, the roof leaks, one of you loses a job for 6 months. Does the math still work? If the answer is no, protect your financial life. If someone who makes $90,000 a year walks into a bank and gets pre-approved for a $500,000 mortgage, that bank isn't giving them financial advice. They're handing them a 30-year stress contract and hoping you sign it. Don't. If this breakdown helped open your eyes, hit that like button and subscribe for more honest money conversations that the financial industry would rather you not have. Thanks for watching, and as always, keep making smart financial moves.